today we have another Open Tribe deal webinar to share with you. I do want to flash up real quick a disclaimer that we usually share just to let everybody know once again. I won't go through all the details of it, but we just like to remind people we're not doing any vetting on this. Please do your own due diligence and check through and be sure that this is an investment you want to make based on your own research and so forth. But absolutely feel free to reach out to the group and ask questions if you have them. I will stop there. And with that, I will turn it over first to Eric Ward from Techvestor. And Eric, you can walk us through the Open Tribe mechanics. Oh, you're muted, Eric.
Sorry.
There you are.
Rookie move. Rookie move.
Oh yeah, I was gonna say we've been doing this.
Only done this like 50 times. Yeah.
Sorry.
All right. So if you normally tune out when I talk about this, there are some changes at the end that I want you to maybe pay attention, and I'll call them out. But most of this is the same as you've seen. So we're opening an Open Tribe for this investment. What is an Open Tribe? It's a professionally managed, completely turnkey, single investment vehicle. Techvestor manages the entire process from the soft commit form all the way to the dissolution of the investment and everything in between. The Open Tribe simplifies passive investing. What are the benefits for you as an investor? For an investor, lower premiums, so lower minimums. You can get into more deals, more diversification, access to better terms because we're pooling capital, access to more exclusive deals if they only want a single check and we have to have a big check. We can do that. The other thing is you get online visibility into Techvestor's platform. You can see your investments. You can see the bank account, the deposits, and the distributions. You get the safety and security of a professionally managed single-purpose vehicle. We're investing as a community. I'm an LFIer. As a community, we decide what we're going to invest in. And then again, simplifying passive investing. So how does it work? So first, we start with a soft commit form, which I'm going to open up today, which we'll send out links to. From there, if we meet the minimum threshold of 100,000 in commitments, we'll then form the LLC. We'll onboard the members, whoever is investing. We'll collect the funds. We'll do accreditation services. We'll communicate with the operator. We'll sign the legal documents, and then we'll invest the money, meaning we'll wire it. So what does it cost? Oh, wait, then ongoing. Sorry, I got ahead of myself. So ongoing from there, once the money is working for you, then any communication that's coming out from the operator will be sent to you directly. You'll get quarterly distributions if they're available. We'll keep the LLC compliant. We'll do the yearly tax services. This tribe is only investing in this single investment. So you will get 1K1 for this tribe. And then at the end, we'll dissolve the services. We'll dissolve the company and shut everything down. So what does it cost? This hasn't changed. It's $150 per member upfront. So that's the first year, and then $100 per year every year after. So what does the $150 do? We get the company formed, pays the Techvestor fees, taxes. $75 of that first $150 are tax fees for K1 services. It helps us keep everything compliant. Going forward, the $100 helps us keep everything moving. And if there is cash flow from the investment and the tribe decides, we can cover future fees with distributions from the operator. And one thing to keep in mind is your first year taxes are covered. So your 23 taxes are covered. So you won't need to have any additional money paid in until late 24, early 25. Okay, so this, if you've been normally tuned out, this is a time to pay attention again because we're changing the form. So if you've looked at the soft commit form before, Brittany with Techvestor has done a lot of work getting a new form set up, and I'll post the link to the new form in the chat here in a minute. But one thing that is significantly different is if you're investing directly with Techvestor or through the Open Tribe, you will use this soft commit form. So everything goes there. I'm showing the question here. If you're going to invest directly, come here, click that button. If through the Open Tribe, click that button. We're sharing this information with Techvestor, and they'll pull that in once we close. So keep that in mind. All commitments go through this soft commit form, which I'll post in just a minute. And if you have questions there, my contact info is in there. You're welcome to call me. or text me. So if you're interested in keeping up with the deals that are going on, shoot this QR code and you'll go to a landing page where Brittany sends out information weekly about what's going on with the open tribes. She'll keep you up to date there. Okay, Chad, I think that is it.
Awesome.
And I'll post in the chat in just a minute.
Okay, thank you. Yeah, a slight change to the process just helps us track who's getting involved in the deal, whether you're going directly to the operator or through us or through the Open Tribe. We will say if you do want to invest directly, and actually in this case, you'll be investing through Impact Equity, but we will send a link to Impact Equity's soft commit page after you go through our soft commit form. So we've got to make sure that is fluid, and we'll ask for feedback and so forth to make sure this is working for everybody. So we know it might be some kinks the first few that we do. So sorry, Randy and Steve, that you're our first ones out of the gate on this, but we'll hopefully haven't made it too complicated anyway. So thank you, Eric, for that. So from here, I'll turn it over to Randy Smith with Impact Equity. And Randy, you can explain the situation, the arrangement with Techvestors. But I will say for anybody that has any questions along the way, please drop them in the Q&A and we'll manage those as we go or at the end. But other than that, Randy, I'll turn it over to you. Thanks, guys, for showing up today.
All right. Thanks so much, Chad. And I believe, let's see here, we'll be getting our presentation up here real quickly. And I'll go ahead and jump in real quick. So first of all, Chad and Eric, thank you guys. We're big fans of Left Field Investors. I personally am part of Left Field Investors. I've invested in a couple of deals, actually including, Eric, you'll be happy to hear, I did actually invest in a tribe a few months ago as well, and it was an amazing experience. So fantastic service there. But today I'm just really excited to get to talk with you guys about an amazing investment with Techvestor and Impact Equity. And this is a short-term rental investment. It is just it's a great investment that's going to provide really good cash flow, and it's going to provide diversification across 100+ short-term rentals in 10+ different markets. And when I say we have high cash flow, we're talking 8 or 9% plus, which really makes this a very good investment, not only from a cash flow standpoint, but from a growth standpoint as well. So I'm going to go ahead and hand this over to Steve, who is the founder of Techvestor, and he's going to start off with some of the materials here. So I'll hand it over to you, Steve.
Awesome. Thank you, Randy. And I had the privilege of meeting Chad in person when we were at Best Ever. So that was a great time to put short-term rentals on the map. Really fantastic experience there with Joe and the team from Ashcroft as well. So really excited to share about what we've been up to at Techvestor over these last couple of years and kind of the behemoth that it's grown into in the short-term rental space. But for many of you, you're very familiar with syndication, so I won't dive too deep into there. But this operates very much like a syndication. The only difference is the asset class is short-term rentals. You don't have to do any of the work. We're buying all these properties all across the country, designing them, stabilizing them, renovating them. And for you as a passive LP, you're getting that cash flow, the tax benefits. We do the same cost segregation studies that you know, like, and love to get that bonus depreciation, no liability with loans and lending. My favorite thing is the instant diversification. You cannot go get this kind of diversification for this little amount of capital in the short-term rental space and do it passively anywhere in the country today. Now, for us, our business plan and our model is very simple. We're buying and aggregating a bunch of single-family homes across markets. And what we're doing to them is we're designing them top tier, furnishing, renovating, adding a lot of value, and really just stabilizing them. The same exact strategy you do in multi, where you're basically stabilizing that yield and that occupancy and those types of things, all the sweat equity. And then we're essentially going to package them up and sell them as a portfolio to private equity, to the retail market, and several other exit strategies that we can kind of tackle. Now, the premium here is being done because of the scale, right? No one wants to own a single short-term rental. If you're an institution, they want to own 1,000, right? They want to write you a $100 million, $10 million, $100 million, $200 million, $400 million check and say, hey, I want to buy this portfolio. It makes sense for significant yield. Now, this isn't our first fund. Last year, we launched Fund 1. We raised over 37 million in equity. We went on to do a little over 75 properties. And our vertically integrated model really allows us to drive significant value through the entire experience. And what I mean by that is the problem in the short-term rental space is typically the owner and the property manager. The owner is incredibly highly emotional, not in touch with the business, and the property manager doesn't care about profits. They care about gross revenue. So for us, we've been able to drive incredible profitability because we own the entire stack through and through. And it shows in our early data where we've been able to drive 71% more revenue, 41% more occupancy. And I'm happy to share that we're sitting here in April 2023, we'll cross over $1 million in distributions already for Fund 1 that will go out at the end of this month. We've also exited 8 times in our first fund. Being able to buy these single family homes based on their values, their comps, appraisal, right, which many of you have probably bought in the past. And we exit them and sell them based on their revenue, not their revenue potential, but their actual net operating income, or also known as NOI. We typically underwrite for a 6 to 8 cap on exit, and we've seen about a 5.4 to 6.5 cap, which is some really great cap rate compression there as well. Now, as Randy mentioned, this portfolio is going to be really, really significantly a scale play, right? And as we're finding and designing these portfolios, your first and ending of your experience in this fund is where you're going to have the lowest cash on cash, but in those middle years, you're going to have those highest cash on cash, but you're going to get those equity plays at the beginning where we're building equity, and at the end when we're dispositioning equity, right? And so I like to think of it as a bell curve. And I think in today's market where there's a little bit of uncertainty in the world and uncertainty in markets in general, it's important to remind us, we have never had a capital call. We can never have a capital call. And these are things that are written in the doc. And we've always been 100% cash flow positive each quarter. Another thing to think about here is our DSCR, for many of you who know what that is a debt service coverage ratio, is a 3 to 1, right? So multifamily, usually at best, you see about a 1.5 to 1. We are more than double that. So our debt will not be a problem, and more on debt later, but it is one of our biggest competitive advantages. We have one of the best operating teams in the space. I'm obviously biased in that nature, and some really great advisors, right? People from AirDNA, Scott Shatford, Jamie Lane, Rob Apostolo, who hosts the Bigger Pockets podcast. We built software that's proprietary to what we do and how we operate, right? And that is another strategic advantage that we do. We do not license it out. We do not share it. It is proprietary to us and how we operate, and a competitive advantage in this fund. So we'll talk a little bit about the asset class. We'll talk about track record, performance, technology, and then we'll talk about the money side, right? How we make it, how we protect it, and kind of the general consensus there. But many of you have stayed in an Airbnb. It's not a rocket science type of an experience, but it's usually been either a really great experience or it's probably been a really bad experience, is what we typically hear. And 90% of the time, these Airbnbs are not being operated as a business, right? They're being operated as someone's home, where they're not really caring for it as if they care about your experience. They care more about their experience. And I think that's been a problem in the space, which we're actually solving because we're running it true like hospitality meets real estate. Our society prefers them. Demand is outpacing supply significantly for short-term rentals, up 3x over the last decade. And the data in general support the growth of the short-term rental asset class, especially from an institutional perspective. It's a $150 billion industry across the country and across the world. Half of that revenue happens right here in the States, right? Drivable destinations from major metros. And we're not in a COVID year, right? And I think we've heard this a little bit over the last couple of years where, we're like, well, people maybe are traveling a little bit more now. Well, we're here in 2023 and we're having the best year on record when we're talking about booking activity, demand, right? And one of my favorites is demand pacing. So not only are people booking more nights, these short-term rentals are more in demand. They're also planning to do so more in advance, right? Through and through. And the data also continues to hold in March, April, and beyond as well. The best thing that I can talk about here at short-term rentals to really bring this down to earth is our competition is moms and pops. Grandpa Bob, Mama Joe, who's got IKEA furniture in the back, renting out a room, really happy, making a few $100 in cash flow a month from their Airbnb, and they're happy. And that's totally fine. There's nothing wrong with that. but they lack all the advantages we have of being a vertically integrated infrastructure. They lack our management, they lack our design, they lack our scale, they lack our infrastructure, they lack our talent. And that vertical infrastructure allows us to go perform and drive significant revenue in a market where we're arbitraging really this lack of experience in this market. You don't see this in multi, right? If you're not top tier in multi, big companies and small companies will take you out very quickly, right? Because it is absolutely institutionalized by larger players. And when you look at a live performance of our first fund, this is for the year 2022. Q1 just closed a couple of days ago, which is why you don't see the data here. But I can tell you, we did more in revenue in Q1 of 2023 than we did all of 2022. And that shows you the velocity of growth. We've continuously beaten every single month we've ever been in business. January 2022 here, we were only live about half the month, which is why you see that being right about 93% to goal. And people are in fact staying in these properties, contrary to popular belief. We do have an incredibly high occupancy. In March, I think, was roughly around 75%. We charge a really great ADR, and we'll get into the metrics here in a bit. But before we move forward, Randy, I think tell people a little bit about impact equity and why you decided to hop in.
Yeah, thanks so much, Sif. And really excited to be partnering with Techvestor. So you guys know a little bit about me and why I'm involved with the organization. I was actually in corporate America for about 25 years and in various sales and sales leadership roles. And I started investing in real estate probably 5 or 6 years ago in the single family space, and then moved into multifamily from a passive standpoint. And at one point, I actually looked at purchasing some individual units to do short-term rentals and found out very, very quickly that I did not have the experience. I didn't have the expertise in property management or acquisition or disposition. So I really started to enjoy the benefits of working in the syndication model, much like many of you, I'm sure, are as well. So I started investing very, very heavily in passive multifamily deals. I started investing in short-term rental funds, self-storage, now industrial, and a number of other different asset classes. And what I found is that my expertise was really around, or my superpower, if you will, was around vetting operators and vetting deals. And since I'd had so much success, I'm actually in, I think, 23 investments as an LP investor now. I started telling all of my friends about this, and they got excited and started coming on board as well. So last May or June, I got laid off from the W-2 one more time and decided to go all in on this passive investing space and help educate and inspire the new passive investor. And that's why I formed Impact Equity. So since that point, I've partnered with 3 different operators, all world-class operators, Techvestor being my second asset class that we partnered with. And our goal is just to put amazing investment opportunities in front of our investors and give them diversification across asset class, operator, market, and deal. So here's where we're at today. We've helped 60 plus investors. We've placed a little over $4 million. And just really excited to be partnering with Techvestor to bring this amazing opportunity to the left field investor community as well. So back to you, Sif.
Yeah, and thank you, Randy, for that. Thanks for the kind words. I think what was really awesome too is Randy actually had an opportunity to go visit some of our properties with Sabrina, who's my co-founder. And it was in Scottsdale, Randy, where you're based out of as well. And
It was.
Maybe share your first look experience. I think that's a great one.
Yeah, so it was a great experience. My wife and I have stayed in Airbnbs like all over the world over the last 10 years or so, and we've become somewhat critical of short-term rentals. Like you said, they're either absolutely amazing or it's a terrible, terrible experience. And I will tell you, with all of the short-term rentals I've stayed in over the years, none of them compared to what I saw with Sabrina when we walked. I think we walked 3 properties here in Scottsdale. One is, I think it's known as the Barbie short-term rental. So it's all pink. It's geared towards kind of bachelorette parties in Scottsdale. It's right in the heart of Old Town. Another was a very, very high-end short-term rental that's probably geared towards more like 2 or 3 families coming together, maybe coming out for spring break or spring training, something like that. And the quality of the finishes was really what kind of jumped out to me. It was far superior to anything I'd ever seen. Steve mentioned that a lot of the time you'll see like IKEA furniture or stuff they picked up at garage sales and things, and it absolutely was not that. So the design on these units were absolutely amazing. I think we'll see some of those pictures in this presentation, but a very, very different experience than what I'd seen prior to that.
Yeah, and the type of product that we put out is really fantastic. And speaking a little bit about who puts that product out, as a leader, there are a lot of things I'm incredibly excited about at this company. But the one thing that I think we have a definitive best in class in is the level of talent on this team. Sabrina spent many years at Apple. She actually built the first AirPods product line and took that to market. I spent 5 years at Facebook building infrastructure and teams for a very long time. And our team who actually goes in and drives a lot of this value is really fantastic. So people like Sam, who's our third general partner and head of capital markets, he's done over $1 billion worth of real estate to date. Mick is our head of asset management. He used to run portfolios at Vacasa, which is the largest short-term rental property management company in the space. People like John Bianchi, who is our head of data. Most private equity firms that you see are on pitches like this do not have heads of data. We are team technology traction through and through. Josh Lewis used to be with companies like DR Horton, scaling infrastructure and single family operations. And I think Randy got that firsthand to see how systematic that is actually to grow. And I think the world took a little bit of notice over these last 18 months where we were privileged enough to be featured in a couple of great spots, things like podcasts and things like online newsletters, as well as some of these major media streams as well. So feel free to go learn a little bit more about the story and such as well.
And see if I could jump in real quick. The one thing that really jumped out to me when I started vetting this group was the quality of the individuals that were working there. After seeing, 50 to 70, probably maybe even 80 different operators in the multifamily space and other space, generally what you find is you might get one or two folks that come together and they probably met at some seminar and they went through some guru. But what we have here is we have experts that have been working in this field or similar fields for many, many years. And it's really, you see Steve and Sabrina taking everything that they learned working for Fortune 100, actually probably Fortune 50 organizations, and bringing that down to this level of fund management, which gives you, the investor, access to the best of the best. And it shows in the returns and it shows in the quality of the assets they put in front there. So back to you, Steve.
Yeah. And I couldn't agree with Randy more. I think the other thing too is we were very cognizant of the things we didn't know, right? And we are an incredibly young, energetic, and powerful team in our space. But we also have some really great white hairs, we like to call them, on the team. Advisors, people like Scott Shafford, who founded AirDNA, Jamie Lane, who's the head of research at AirDNA, Lawflow, with previous stints at places like Citadel, Uber, Realtor.com, where he was the SVP of analytics and data. Rob, who's the host of Bigger Pockets podcast. Each of these individuals adds a ton of value, opens up doors, right, in a very early asset class, right? We're in the first or second inning, right, of what this asset class will be. And it's very much where multi was a very long time ago, where storage was in the 90s. And as institutions come into this space, they want to buy the product that's already complete. They don't want to go do the work because it doesn't make sense for them. And that's a clear value add that we're able to offer. And our team is really one of the only ones that's vertically integrated in the space that's able to actually go execute this. So while the team is incredible, we've also built some really fantastic technology. In fact, when we started, we were a software company. We thought, we'll help people buy short-term rentals, help them identify the best possible properties to buy. And early feedback was software is great, but they didn't need it after they found the property, which is typical in software, right? It's called churn. And that wasn't a really viable business model. And then once they bought it, they were like, I don't want to operate it, right? That was really the main pain point that they had. And what they were describing in our early onset of a company was, I just wish I could invest in short-term rentals, get the benefit of the returns, maybe use it from time to time, but not actually operate it. So our software today is proprietary. It allows us to identify all of these typical types of things: what to buy, where to buy, the type of product to buy in that market. Does the real estate supply actually allow us to scale in that market, how to operate? And everything through and through across a dozen plus markets in the country. This is a huge, huge, huge value, being a part of a syndication with this level of geographical diversification, seasonality diversification. asset-based diversification within the fund itself. We're in places like Scottsdale and Memphis, the Poconos in Pennsylvania, Blue Ridge, Georgia, Panama City Beach, Clearwater, Tampa, Memphis, Galena, Illinois, Branson, Missouri. We're looking into the Asheville Mountains in North Carolina, McGaysville, Virginia. And some of these you might be like, can I really make a lot of money in these areas? And the short answer is yes. Every market is actually investable, but we've identified these markets where the level of talent and the bar there is actually so low and the demand is so high that the arbitrage is actually fairly simple, right, in terms of scale. And each property goes through a very rigorous 16-point strategy. And I won't go through every single one here. You can definitely read them. But the most important one that we look at is our ADR. And ADR stands for average daily rate. The reason we look at a $200 plus average daily rate is because we do not want to compete with hotels. Hotels will always win because they can beat you on price, typically. They can beat you on location, and they can typically beat you on driving that price down to zero with things that they can offer unrelated to price. Where we win is on amenities. We win on design. We also win predominantly on price for the type of product we buy, because we're typically buying 4 bedrooms and larger homes. If you've ever gone to a hotel with 8 to 10 plus people, you know the friction of what happens as soon as everyone walks into that elevator and you start going to your own rooms, whether it's on different floors, same floor. There's quite literally a friction of space. We do not have that. And it's way more economical to stay in one of our Airbnbs if you're a group of 6, 8, 10, 15 people than it is to go to a hotel. And it's better design, it's private, better amenitized. And usually for the people that are going there and what they're doing, families, which is the predominant category of avatar that we target, much better experience as well. And as a father of 2 under 2, I can personally speak to this as well. Everything we do is also vertically integrated. When we first started, we didn't think about the importance of how much this would actually play out. And hindsight's 2020. I can tell you, after a year of being vertically integrated, this has been by far the biggest blessing we've ever done in our company. We own the acquisition channels, we own the design channels, the renovation channels, the pricing channels, the management channels, everything through and through. There's no red tape in our company. If we need to put up pricing, reduce pricing. And if you go back to what I mentioned earlier in this webinar, the problem in the industry is the owner and the property manager predominantly, right? That's where a lot of the arbitrage happens. And we've removed that completely by being a vertically integrated business. Now, let's look at some photos, because I think photos speak a million words than just some words that I'm speaking. Here's one of our Scottsdale homes. And I'm not sure, Randy, if you walked this one, but I know you walked the Barbie one. But this is one of our OG homes. Where we bought early in our first fund. And this is a great case study because it was doing about $140,000 a year in revenue when we bought it. It wrapped up its first year in mid-March, and it crossed about $211,000 in revenue. So about a 50% increase in year-over-year revenue from simple renovation, better operation, better revenue. I'm going to sound like Papa John's if I don't stop. But the point here is, what did we do differently? And when asked this question, usually my answer is, this is a cohesive property. If you look at the photos, if you look at the design, if you look at the way it was managed and approached, this property is cohesive. And that's unfortunately not what you see in Airbnb. Simply by being cohesive, you're already a typically elite property. And that's a very simple thing to do. We win on pricing, we win on size, we win on amenities. Or for example, like this Poconos cabin here, where we took from really old and rusty to really open and industrial. This is a market where the design bar is incredibly low, right? When you look at these photos and you're on Airbnb, because all Airbnb is a user product where they have a journey that they want you to actually go through. It's going to be very clear which one you're likely to stay in. One seems more inviting and one does not, right? Again, very similar to multi, or that Barbie home that Randy was mentioning earlier. This home is incredibly cohesive. It's on brand, it's on point, it's well amenitized. You have an experience here for the reason that you're here, right? It can seat enough people. This home sleeps about 14 to 16 people. This couch, those chairs, those stools, you can clearly envision yourself here with your group, right? From the vantage point of the camera. And those are things that are very important. Stock tank pools and modern design in Memphis. These are not things common in this market, right? But this market has a high density of families visiting that want these amenities, but they can't find them. right? And so when we're able to build them and add this type of value, those are things that are really important as well. And again, just typical modern clean design in a lot of these things. You see this in multi where, the business plan is, walk in, renovate 85 units, upscale the kitchen, add some cabinetry, new appliances, and push rents up. Not rocket science, very similar to what we're doing here, and it's all about execution. So kick it back to you, Randy. Talk a little bit about the incredible benefits of investing with impact equity and the numbers here.
Absolutely. Yeah, thanks, Steve. So a lot of this we've already talked, but I do want to highlight a number of these items. So we mentioned earlier that our minimum investment is $25,000. It was important to me that we put the minimum investment at a level that I think would allow more people to participate in. This gives this investment opportunity with diversification to a much broader audience than those where you have $50 or $100 or even $250,000 minimums. So excited to be able to do that. This is a, kind of the standard 5-year pro forma that you see in most syndications that you're probably seeing through left field investors. Our plan is to exit this between 4 and 6 years. This won't likely be a 2-year turn that we've seen on some of these in recent years, but if the opportunity were to present itself to exit to private equity or REIT, then we have the ability of doing that. Really important thing here as a private investor, or I'm sorry, a passive investor myself, is 100% of the tax benefits go to you. So yes, you will get probably a 20% paper loss year one. And what I'll share is that Impact Equity, we just sent out about $1 million worth of passive losses in K1s, and the excitement and energy from our investors when they bring those to their CPAs and see the impact that has on their tax liability is just astounding. So if you haven't experienced that yet, this could be a great opportunity to do so. We're going to do quarterly distributions. And I noticed in the presentation earlier that it said even with the Open Tribe, they're doing quarterly, so that'll match perfectly with this. And the big thing that I mentioned earlier is this cash flow difference. And being a really heavy investor in multifamily up to this point, I was seeing 3 to 4, maybe 5% cash flow on my LP investments. So to be able to get to 8 to 9% average cash flow is probably 30 or 40% higher than what you would likely be getting if you were in multifamily or even self-storage or industrial for that matter. And then of course, the goal here, we'll get into the equity multiple later, but our average return annually will be between 18 and 20%. And then, as we've mentioned a few different times, diversifying across 100+ properties in 10 different states really protects your investment dollars to make sure that you're getting consistent returns. So now this is truly the money slide. This is the impact, why invest with impact equity with Techvestor slide. So we all know what preferred return is, and this is a modest 8% preferred return, which means the first 8% of profit, excluding any fees, goes directly to the investors. So the operator, the fund, we don't earn a dime until our investors get 8% preferred return. Now, the big differentiator here is our waterfall above the 85%. I'm sorry, above the 8% pref is 85%. And Steve mentioned earlier, if you were to invest with Techvestor directly as a retail investor, this waterfall would be a 50-50 waterfall. And there's a number of other operators out there that do 65-35 or 75-25. To my knowledge, 85-15 is the most rich waterfall that is in this space. And this is important to me with impact equity because my goal in all of the investments that I provide my investors is make sure that investors and operator incentives are aligned directly. And this is clearly doing that. And then, of course, this is a passive investment. So once you vet the deal, it's passive income from there, and you just sit back and collect the checks. So this is the investment summary slide. I'm going to just point out a couple of different things here. We've talked about a lot of these numbers, but our projected equity multiple is a 2.02x, which is in to my knowledge, the best equity multiple provided by Techvestor and in this short-term rental space available in the market today. Going down a little bit further, you'll see the internal rate of return, which essentially is a return metric that takes into consideration the time value of money. And the reason why our IRR is significantly higher than other offerings out there is because of the cash flow that we offer throughout the entire hold period. So without the cash flows that you're seeing year 1 through 5, this would probably be in the 14 or 15% range. So the cash flow is a big deal here. And then lastly, I want to point out, if we can, the top line of the middle section, which talks about cash flow percentage. You'll see here that $100,000 investment is going to give you almost $5,000 year 1, a 5% return year 1. Year 2, after we buy the assets, design the assets, get them in place and get them rented, you'll start earning 8.9% plus. And then years 3 through 5, we're in the 10% range. You just do not see cash flow like that in multifamily or many of the other asset classes that are out there. And this specific reason alone is why this is a fantastic cash flow in combination with growth investment opportunity. So you'll see here, and you can read these details later. There's a lot of discussion about the 8-pref 85-15, but equity multiple, IRR, and annual cash flow are the big takeaways from this slide.
Yeah, and I can't stress it enough. Randy's right. If you were to come to us with a $25,000 investment, we would not offer you an 8 and 85. The predominant reason this is being able to be offered through Impact Equity and through the partnership with Left Field is because the community, and as Eric mentioned earlier, through the tribe, you are writing a much larger check as a community. And Randy's able to offer those terms as well. So without further ado, let's also talk a little bit about taxes. So we definitely enable cost segregation studies across the portfolio per home. You can expect roughly a 20% to 30% write-off or a paper loss over your first couple of years, depending on when those properties are put in service, as they call it. But we definitely will take bonus depreciation to offset as much of that income in real time as possible and defer and kick the can down the road. Now, opposite to taxes, and of course, this is not financial advice, please consult with your CPA or financial advisor. One thing I can advise you on is you're an owner, so stay like one. Randy had the opportunity to visit them, and I think he really got a great experience from that. This is one of the few investments in the syndication space that really gives you utility. You're never going to stay in a storage box. You're not going to go rent out an apartment unit just to rent it out. But in this experience, you are an owner of the entire portfolio. You can go stay in any of these properties, as well as any historical properties we did in Fund 1. So you have access to over 100 plus properties across dozens of locations across the country. You're going to be able to book direct. It does not impact the investment. We're still getting that same net income we would have gotten if we got a random booking online. But it is kind of nice to have that utility for yourself, for your friends, for your family, if you're thinking about lifestyle as well. Now, let's talk about some of the things that I think are incredible about this investment compared to commercial or traditional commercial real estate. First and foremost, we're buying properties based on value and then immediately, mini developing them, for lack of a better word, into a different asset class altogether as a short-term rental without actually doing development. We're seeing development-like returns without taking development-like risk, right? Those are some really fantastic analogies to really understand the risk adjustment in this type of investment. Secondly, every time we buy a property, we're doing extensive renovation. I'm talking about floors, kitchens, bathrooms, amenities on the outside. I encourage you to go look at some of our properties. And in fact, I might pull some up here at the end, some of our most recent ones, so you can see the types of amenities and yards that we put together for some of our Scottsdale homes, for example. The reason this matters is we're buying properties typically below value based on their appraised value, right? Typically getting a few percentage points off on average. We're forcing significant value, therefore increasing our equity in that property respectfully, right? And that will only go as far to tell us that we're having all that equity tied up, we're at that sweat equity. But in addition to that, we're getting really fantastic debt. And this is the big thing that I want to talk about. Our debt structure is fixed for a minimum of a decade. If you've invested in multi, you'll know that usually at best you'll see 5 years fixed, maybe a 3-1-1, or none of that, right? And a lot of floating rates and no rate caps being bought, especially over these last couple of years. And I think we'll see some of that come to fruition in 2023 and 2024 and 2025 if people are we're a little bit more aggressive with their debt structure. All of our debt is fixed for a minimum of a decade, meaning we will never be a forced seller. We will never have a balloon payment. None of that will ever happen. And because of that, we feel incredibly confident that over a 5-year life cycle, and if we needed to extend for whatever reason, we are going to be more than good. Debt is the silent killer that kills all, especially in the real estate space. And you go back to 2008, which is the most common one that people kind of think about. 90 to 95% of what happened in 2008 was floating rate debt, balloon payments at an inopportune time. They were forced sellers, unfortunately, and they were forced out. They lost their shirt. The other kind of unique thing in our portfolio is every single property is its own individual loan. There's zero cross collateralization here. So for the sake of an analogy, you could lose a pinky and still survive, right? And that's really important. And, thinking about growth planning and, well, what if this happened? Well, what if this market did that? Or what if this property went to shit? If we wanted to sell it, could we do that? We can do all of these things. Typically in commercial, you can't sell a property without calling the rest of the loans up, right? Here, we can sell strategically if we wanted to. We can disposition strategically, right? And all of that kind of goes to say that, first and foremost, this is not 2008, right? Where we have significant equity in homes. We do not believe there will be a housing crisis due to lending and banking infrastructures, even though with the collapse of SVB, right? I get it. There's fear in the markets, but this is not 2008. Lending is actually incredibly strict and tight right now. And I think anyone who's in this space can tell you that, right? A true, honest opinion of that is if you don't have good relationships with your lenders right now, you're starting to see it. We have exclusive relationships with our lenders where we can actually buy single family homes. They're underwriting them as short-term rentals with discounts on the rate because of our institutional operation. You could not go get our rate with our lender underwritten in the same way that we could get today because of our operation and because of our track record. Also, better borrowers today than ever before, right? The Dodd-Frank Act, the Freddie Fannie was implemented in 2008. All these types of things will tell you that we're not in a housing crisis. I do believe housing prices will compress, and in fact, they've started. Arguably, that's a huge reason to consider investing, right? We have this pendulum where revenues are increasing, ADRs are increasing, but home prices are coming down. So you're able to buy the same home, the cost basis of being lower and being able to drive more revenue. That's a great business to be in. And for anyone who wants to say, well, interest rates are too high. Interest rates are always ever changing and always cyclical. We also have one of the highest yielding asset classes in real estate where we can stomach a lot easier higher interest rates, and it's fixed. If interest rates come down, we will unlock a significant amount of cash flow through rate and term refinances. And we look forward to those days that happens if we're still holding these assets. So can someone compete with us? What does the competitive landscape look like? The short answer is they can try, but they would need a lot of money and a lot of great people and a lot of will to go do what we've done. A vertically integrated infrastructure like ours across dozens of markets, dozens of seasons, dozens of weather, understanding the hyperlocal data of what to buy in these markets would take an unreal amount of time and money for someone to go do this, let alone they would actually have to have the talent to go execute it. And we don't believe that that's the case today. So Randy, Impact Equity has been partnering with us. We're extremely excited. If the left field community is looking to get involved, what does that look like?
Yeah. So we heard earlier that you guys will have a unique soft commit button that you will go ahead and click the link and determine whether you're investing with the tribe or investing with us directly with a $25,000 minimum. Once you do that, we will actually get you into our portal, which will give you access to all of the legal paperwork that if you're a repeat LP investor, you've seen this multiple times. There is nothing different with our paperwork than anything you've ever seen before, but it can be a little time consuming. So dedicate some time to review those materials. You would then fund the investment We're accepting wire transfers, and I'm actually working on ACH payment as well. Hopefully we'll have that in place in the next week or two. And then from there, we do all of the rest of the work. So the funds are deposited, we go out there and start finding the assets. And then with a short period of time, you will start receiving your quarterly distributions and then K1s as well. All right, so at that point, you will start to get quarterly reporting from us. You will get quarterly dividends. It's 100% passive. And I think if you connect with us in multiple channels, you'll see we're putting a ton of content out there regularly. Seif and the team are doing some fantastic reporting and presenting information to us. This you will see is a dedicated portal assigned specifically for this fund. It won't have any other funds in there or investment opportunities. It is a partnership that we did with InvestNext to create a very fluid, very understandable, easy workflow process within this portal. And then finally, we just thank you for joining us today and spending about 45 minutes with us. We've kind of scratched the tip of the surface of all of the information that we can provide to you. So what I would encourage you to do is, if you have questions, certainly schedule some time with myself. If we have more detailed questions that we need to get Seif and the team involved as well, we can certainly do that. But we greatly appreciate your time. And thank you so much for spending the last hour with us. Thank you.
Great. Thanks, guys. Appreciate the offering. Appreciate the terms on there. That's really nice of you guys to support the left field community in that way. I will ask, and forgive me if I missed it in the presentation, are you only taking accredited investors, or do you open it up to non-accredited as well?
I think you're on mute.
Yeah, very good question. So this is a 506c offering. So we are only taking accredited investors for this investment.
Very good. We'd like to get some clarification on that as well. Again, to the group on the phone, if anybody has any questions, please dump them in the Q&A. We'd have one sitting out there that is a question of what are the fees related to this. I don't know if that was specific to the tribe or if that is talking about the fees that you guys charge, but if you guys could walk through again just what your fee structure is like, that'd be great.
Yeah, absolutely. So Impact Equity, we do charge an acquisition fee of 2%. And then Seif, I don't know if you can talk through the fees that are affiliated with the organization, but from an Impact Equity standpoint, it is a 2% acquisition fee. And that essentially helps to support our portal and marketing materials and events like this, of course.
Yep.
But
So
Seif, any other fees that are relevant?
Yeah, on the Techvestor side, we don't charge any AUM or acquisition or anything along those lines. We would be charging that essentially to the LP, which in this case would be Impact Equity. We don't charge any of that. We do have obviously costs of running the fund, just like you would have in any other asset class. You have property management, asset management costs, the fund filing fees, all those types of things. And our operating model is, incredibly unique in doing so, but we don't charge any traditional AUM, dispo, acquisition, recourse debt signing fees, like those types of things. We don't charge that.
Yep. And actually, that's a good point. Impact Equity does charge a 0.4% asset management fee to cover the portal fees as such. So let's see here. From a co-GP, I see another question here. What is the co-GP investment commitment? I personally am investing in the fund as well, at the minimum at this point, but it's possible or probable that I will increase that investment. Seif, can you talk to the co-GP investment from the operator standpoint?
Yeah, we'll be in well over $1 million on our end, depending on the size of this fund, and we'll probably scale that up as equity also raises as well. So we expect to probably be no more than 2% of total equity, specifically because we also fund a lot of other things on the front end, and we don't obviously charge traditional fees, right? Like acquisition and AUM and those types of things.
And then I see a question about the timeline. We actually will be doing, we will have individual tranches throughout the year. And our first deadline is April 14th. So probably April 13th, funds would need to be wired to get in the first tranche. And then I believe we'll have a second tranche that will be coming 2 months after April 15th. So April, May, June 15th, I believe. See if anything to add there.
No, we raise money every 2 months, right? Realistically. So you look at 4/1, 6/1, 8/1, 10/1, 12/1. The advantage of getting in earlier is going to be your pref will accrue faster. So unless your money is making a significant amount of money somewhere else and it's just sitting there, probably best to invest earlier is my guess.
Perfect. And there's a question here, Seif, about exit strategy. I think you can probably answer that better than I can.
Yeah, so the question asks, is the ideal exit to a private equity firm or institutional? And the short answer is yes. We've had significant interest from institutions already. And their main thing that they're really attracted to is the level of scale that they can enter the space with, which they can't find on the open market today. If for whatever reason that isn't an option, we can exit each property individually on the retail market. It's totally an option. We can package them up by market, say, for example, the Florida portfolio, the Arizona portfolio, the Pennsylvania portfolio, all those things can be segmented as well. All of our properties qualify under SBA loans as an example. So each SBA loan can go up to, I think it's around $5 million on one of their levels. So each property could theoretically be sold for anything less than $5 million, which would be an incredible exit for property, of course. Given our average purchase price is in that 550 range, would be more than good. So lots of options that we can do on exit for sure.
Right. And then see if it looks like there's a question as to whether this is a composite or individual state K1.
Yep. So we will always issue a composite if and when we can. Each state has its own requirements for if we can or cannot do that. But for everyone's sake, we will always do a composite K1. It's easier for everyone involved, including myself.
And I'm curious, Seif, with Fund One, was there, I know we were in 10 plus markets. So how many of those were not, were individual state then?
I believe we were in, I don't think off the top of my head, I think that was across 4 or 5 states.
Okay, perfect.
Yeah, roughly.
And then let's see here. So we discussed the exit strategy. Okay, we already talked about that. Average loan to value on the properties. Do we have that?
Yeah. Realistically, we like max leverage, and max leverage in this space is for us typically 80%. For most others is likely going to be 70 to 75. But because of our institutional historical track record, lenders can give us and want to give us up to 80. Remember, we have a much higher yield than traditional, and we're still driving 3 times the revenue as our cost of debt, or sorry, our revenue, our NOI is 3 times the cost of our debt. So we are typically very healthy to go up to 80. I think Fund One ended up right around like a 76 LTV realistically on a blended basis. But I expect us to realistically be around that 75, 76 number. And that's before it's before the equity that we're adding on renovation as well.
Perfect. And I didn't, this was not discussed, but cost segregation, I believe we're doing cost segregations on these, correct?
Yes.
Okay, my understanding, and this is not tax advice, of course, but my understanding is that the higher LTV, the better depreciation that you experience. Are you familiar with that, or can you talk to that at all, or?
Yeah, I'm not 100% sure on that specifically. And again, not tax advice. What I can tell you is the improvements we make to the property and our ability to depreciate faster. For example, in this asset class, furniture is depreciable over a 5-year period. Standard typically 5 or 7, and we can do that on an accelerated basis. The asset itself can be depreciated on an accelerated basis. I think we were nicely surprised with the increase in depreciation we received in our first fund, more than expected. So we're typically fairly conservative on our assumptions there.
And can you share where Fund One percentage of year one investment as a passive loss fell?
Yep. So we look at it on an aggregate basis. And remember, last year we were at 100%, and this year the IRS has it down to 80%. So it won't be perfectly apples to apples, but last year we were roughly on an aggregate basis around 45 to 50%.
Okay, perfect. And that, I believe all of the funds were not even put in place by the end of the year.
And that's
so
what I mean on an
potentially
aggregate.
higher. Yeah, interesting.
Yeah,
okay.
On an aggregate.
So So this year we could expect potentially that, but then of course we've got the step down to 80%, so that'll impact it as well. Okay, very good. Thank you. And I think Chad, that's all the questions. This is my first time using the Q&A function in this, but I might have closed some out. So if there's any that we missed,
I think we got them all. Yeah. And we always say, you know, the community can feel free to reach out directly to Randy or Steve if you have other questions and get in contact with them. But no, appreciate you guys coming on and sharing the offering today. Looks really interesting. So thank you for the time.
All
Yeah,
right.
thanks so much,
Thank
Chad.
you.
Thanks, Randy. Thanks, Bill.
Thanks, everyone.
Awesome. Thanks everybody for joining in today too. Thank you.